I've been trading and investing for over 15 years at this point. First in stocks on the London Stock Exchange, professionally there, and then as crypto came along, I moved over. So I want to boil down what I've learned in those 15 years in this video about asset classes, returns that you can get, how to take risk in a broad sense so that you can build a base and then work off that individually and choose what you want to invest in and how you want to invest and trade. So this video is going to have timestamps down in the description for all of that and some more specific guides as well. If you want to know like how to actually press the buttons to go ahead and trade, I'll leave all of those free videos on YouTube down in the description. I also have a crypto course. You can check it out. Specific short videos telling you exactly about everything in crypto if you're after that. All linked down in the description below. The first thing that we have to acknowledge and accept is the type of market participant that we are. We are retail traders, and that means we cannot compete with professional traders at their game. If we swim with sharks, we are going to get wrecked. We do not have the information, the systems, the algorithms that these trading firms have. Plus, they are mostly market makers, meaning they see both sides of the trade. They can sit in the middle of it. We do not have access to that information, right? I used to have a Bloomberg next to me. I don't have that anymore, all right? And so we have to understand where our advantage is. And it is certainly not day trading and trading ticks in the market over minute timeframes. We are going to get wrecked. Now, there are specific strategies for that, but that is not a long-term trading strategy that we can implement. Look at these guys. These are market makers. They have billions behind them. They trade hundreds of billions into the trillions of trade volume. We cannot compete and win at their game. They just simply have way more than us. So where do we excel? I think retail investors excel in higher time frames, longer term thinking, right? So actually saying how am I going to outperform over a 10-year time horizon. And if I do have trades that I want to implement over weeks or months, then there's specific trade ideas as well. But trying to compete against market makers who have these systems, trading ticks and seeing trade volume, we can't compete there. And I do think that you are going to lose if you try to compete against these guys. The next thing to realize is how asset prices move in general, because everything is traded against a fiat currency. We measure everything in a fiat currency. This took me actually years to realize. It's that the value of assets is priced in a fiat currency. Everyone always looks at one side only, which is the asset itself, but they ignore the other side of the trade, which is the fiat currency. And so both of these things can go up and down in demand at certain times. It's the fiat currency side that is way stronger in the short term. And so when you're trading short term, what you're actually trading is not just the asset and the demand for that, but the other side as well, which is fiat currency. It took me years to actually figure this out, that the vast majority of asset returns are because the fiat currency is debasing itself and getting cheaper over time. It's getting more abundant. Fiat currency, dollars, pounds, euros, these are a currency that is based on credit. Banks create credit and they literally create more credit units over time. Central banks print money sometimes as well, which literally increases the supply of that half of the trade. If you are in an asset that has a certain level of demand over time and it doesn't debase itself as fast as that fiat currency, both sides of that trade are going to move. And so the asset is going to look like it's going up in value. It's all about relative purchasing power. We can then look at assets like this over long time frames and decide which ones we want to, over time, just get our assets into. The whole entire game of investing is getting out of fiat currency because that is a credit unit system that debases itself over time. And so we need to go into assets. That is a huge leap to actually go that far. Once you're in assets, you can then look at how assets perform over time and decide how much risk and volatility do I want to take and what are the returns I'm getting for that volatility. Like volatility is how much is the thing probably going to move within a 12-month time frame. You can look at the volatility of that. So if it's going to move 50%, that may be a 50 vol asset, right? Which means wherever you're buying from, right, can go up or down 50% just normally because of the volatility of the asset. So think about this. Every time that you get your wages, some of that is going into assets. Which assets do you want to go into and how is that going to affect your lifestyle with the volatility there? This is every single day, over time, over the long term, how you just chip away and make returns over and over and over without even having to actively trade or anything like that, which we'll get onto later in this video. So let's look at asset class returns. Number one, right, is that you absolutely cannot buy commodities, okay? Commodities do not go up in value. They're the only thing in this whole entire sheet that has actually gone down in value, right? So you can't buy them. And you hear people saying, well, I'm going to buy copper now because I think, what are you buying copper for? It's absolutely ridiculous. It's not an asset, right? When the price goes up, people dig more out the ground. So let's think about this. What is actually giving us returns? You can see that cash and debt gives the lowest returns and the lowest volatility. Then you kind of have stocks here, right? So US stocks or emerging market stocks, they're all right about here, right? So higher volatility, higher returns. And then up at the top, BTC, the number one best performing large scale asset, annualizing 145%, more recently annualizing at around 40%. So you have assets, you have a volatility of those assets, and they give you a certain return over the long term. So you can just drip feed your money into the market and actually outperform and get annualized returns over and above the fiat currency that you're using. Now we'll look at currency debasement because it's super, super important to drill this home. You're looking to trade, you're looking to invest, you want to make money, right? And I know that the kind of mental framework that most of us have is I have a job and I exchange my labor for money. And at the end of the week, I put effort in and get the money back out. That is not how markets work. That's not how money works. That's not how trading works. Okay. This is long-term stuff where you have volatility and you have outperformance. And all you have to do is expose yourself to it and be consistent, and you actually just outperform over time. The way you make the most money is not risking all of your stack every single time in a trade. The way you make the most money is just absolutely pounding and pounding and pounding over the long term, just getting your portfolio bigger and bigger and bigger and exposing it to this outperformance versus a fiat currency over time, right? If you do this year after year after year and you grow a big stack, in a few years, in a decade, you're gonna have a big stack, and then suddenly the market moves 15%. You've literally done nothing. You've not traded. You've not pressed any buttons, and you're up 15% on your money because the market moved and you have been saving and growing your stack over time. That is the sweet spot. And unfortunately, it takes time and it takes effort and it takes a way of thinking over the long term. Most people want to hear that there's a button you can press and there's this thing you can do on the 1 minute chart. Unfortunately, that's not going to work long term. And so you have to just change your lifestyle and your way of thinking. This is what we are defending against, which is the debasement of fiat currency, which is what we use to price all of these assets. So this is the trade. This is the only trade of your whole entire life. You can see that currency debases itself. The money supply has increased and continues to increase and never goes down. The rate at which money supply grows and contracts, you can see that here. So there are areas and there are cycles where money supply grows and contracts and grows and contracts and grows and contracts. And you can actually see that the price of Bitcoin and most other risk assets will actually go up and down in relation to that. As money supply grows, so does the price of Bitcoin. As money supply contracts, Bitcoin obviously feels the heat. As we go up again, we have a growth period, right? A reduction, a growth, a reduction, a growth. And that's how it works in cycles. So really important. Over the long term, currency debases itself by around about 7% a year. That is the annualized long-term rate of currency debasement. So 7% currency debasement. This is the US dollar, by the way. If the currency is debasing 7% a year and the asset that you hold is going up 7% a year, your real return is nothing. Because like I said, everything is purchasing power parity. It's not about returns or anything like that. It's about how much are the price of things going up and is the asset going up at or above that. If your asset you're invested in is going up faster than 7%, you are actually making real wealth because your purchasing power is increased. If you're at 7 or below, you're either losing money or not making any money. So that is very important to understand. Housing, as you've seen in this right here, goes up around 8%. You can screenshot this, 8% a year for housing, and the currency debasement rate is about 7%, being kind to currency debasement. Other fiat currencies much worse. You're making about 1% a year in housing, which is basically nothing. So you don't make any money in housing. S&P goes up 14%, minus 7, it goes up around 7% a year. Decent. The NASDAQ has annualized around 19%, -7, you're up about 12% a year. Bitcoin right now is annualizing around 40% a year, -7%, around 33% a year. So 33% a year, if you think about it, you just be consistent over time. That is outperformance. That is actually making returns. You don't even have to trade or any strategy. It's literally just outperforming fiat currency. And you can have any mix of these that you want. It's important to understand the long-term implications of this because it's going to affect the way that we trade. People want to make money trading. What I'm saying is, if you just buy and hold BTC and invest regularly, you're already making an annualized return around 33%, right? Net positive, or a 40% return if you're just taking the actual returns of BTC. You're trading, if you want to trade short-term and have short-term trade ideas, you need to make way more than that over shorter periods of time to actually outperform just putting it in BTC and waiting, which is less risky, right? Less volatile, etc. Less chance of actually making losses. Because if we look at the BTC chart, what we're seeing is we're at an all-time high, which means anyone that has ever bought Bitcoin is now in profit, which means the whole entire market for 15 years, hundreds of millions of people have a 100% hit rate on their trading. Every single trade has made money for them. When you trade shorter term, you're looking at 50% hit rate at best. And so the returns that you expect to make have to be very high in percentage terms to actually outperform this. Because if you want to be trading for the long term and actually make money, that means you have to be trading for 5, 10, 15, 20 years, even longer, your whole entire life. And so if you're constantly doing the 50% hit rate strategy, right, eventually you're going to lose out at some point. And if you mismanage, you're actually losing money. Whereas people that are just into BTC growing over time have a 100% hit rate. It's important over the long term, these odds actually matter. So it's about this strategy first and then trading shorter term with smaller parts of your portfolio if you think that opportunities exist. Now I want to touch on CAGR and ARR. CAGR is compound annual growth rate. ARR is annualized rate of return. Basically the same thing. How much does an asset on average move each year? Then we can put together essentially a trading portfolio investing in that. And we can wait. And if there is a specific opportunity to actually outperform short term, we can then take that. But you need to have the base first, right? You can't be constantly trading thinking, I'm just wanting to make money. Where's that money going to go? It shouldn't go into cash, right? Essentially the trade here is getting out of fiat, making sure you're in assets over time, building that base. And then you can give yourself space and time to actually then take riskier bets. Because if you're up 5x on your investments because you've just dollar cost averaged them and been in over time, you now have strength in the market. You can wait. You don't need to be desperate. You don't need to take trades just because you want to make money. And that's all of the things that people lose with. So compound annual growth rate, like I said, for the S&P, you're looking around 14%, NASDAQ around 19%, Bitcoin around 40% right now. Go to Glassnode, I'll link all of these below. The orange line is the compound annual growth rate of BTC, around 44% right now. If we look at Ethereum, the compound annual growth rate, just above my head here, looking at around 60%. Right, very, very good returns. If you can't trade that, if you can't outtrade 40 to 60% a year, you literally just need to buy and you don't need to do anything and you can make those returns. That is the bulk of any portfolio, to do that consistently in assets that outperform. That is going to give you the best hit rate over time to make money, to relax, to gain strength, to gain assets, right? To gain quality. Then you can trade whatever you want after that with small parts of your portfolio from a position of strength. We can trade and invest using buckets, and this can be specific amounts that you want, or it can just be done on a feeling basis. But we have essentially 3 buckets here, right? Investments, trades, and cash. So investments, constant outperformance, long-term outperformance. So whatever that you want, if it's the S&P, the NASDAQ, Bitcoin, ETH, or maybe just I want exposure to crypto, I've got 10 crypto assets here, I think they're going to grow over time, right? It's up to the individual, but these are investments that you have. You invest early and often and over time to outperform the fiat currency. That is going to give you a great solid base. If you don't have that, then what are you doing? If you're trying to trade all of the time over and over, putting yourself at risk all of the time, you're in a weak position there. Once you have your investments and you have that strength, we can then go to trades, short-term ideas or specific ideas. As of making this video, crypto went wild, basically at all-time highs because of a Republican win in US election, right? And that was very positive for crypto. An easy trade idea, right? I'm going to buy months before the election. I'm going to hold through the volatility. And as the election comes, if I think that side was going to win, that's positive for crypto, then we can go ahead and trade that. Now, that's risky, right? Because the side that you think may win may not win. And so the price may get drawn down. So when you're trading, you're opening yourself up to more risk. You can make some profit short term, but there's risk there, which is why that trade bucket is always got to be smaller than the investment bucket. It has to be. Now, with cash, we always need to make sure that the volatility of these two things doesn't wreck our balance sheet as a person. We need cash. We need working capital for any eventualities. If we lose our job, if our income doesn't come in, whatever else, we need to make sure that we can pay the bills and do everything there. And that's not taking away from our investments. If we're putting too much into these, the market has a way of embarrassing all of us over time, right? And if we're in a weak position, we'll get wrecked. So we need to make sure that we're in a strong position, that our lifestyle can be taken care of, and then our investments and our trades can also take care of themselves. These are just cold, hard facts, percentages, profits that you think you're going to make, right? And the balance of a trade. If a trade is 50-50, you can't go all in with your stack. If you think a trade is 50-50, you have to make sure a specific percentage of your portfolio is risked and then move on from there. It's all about percentages and odds and just playing the odds over time. Before we get on to specific trade ideas and more active trading and how to manage risk around that, I want to hammer home the power of compounding assets and outperformance over time. This is the basis of everything, and you must build off of this foundation. This is something that I had to learn when taking my broking exams. 1 plus R to the power of N. So this is a annualized rate of return calculation over time. So 1 plus R is the rate. So 1.25 would be a 25% annualized return to the power of N, the number of years of that compounding. And you want to do that, you can do that calculation, or just go to ChatGPT or whatever you want. I put this in here so you can explain it now, right? And they'll tell you what this would do. So I said, I initially buy $1,000 of Bitcoin at 50,000. Then once per year, I buy $500 more, $500 more. And the Bitcoin CAGR is 25%. I do this for 10 years. It works it out. And it tells me down here that after 10 years, you turn essentially a $6,000 investment, which is $5,000 over that 10 years, $500 a year, plus the initial 1,000. So $6,000 investment, which is compounded to almost $26,000. This is the outperformance. You don't need to trade. You just need to invest in assets that will outperform and be consistent. Then when you're having these profits and you see that, volatility is irrelevant for you. Everyone says Bitcoin's volatile. It doesn't matter if you've made these returns over 10 years and Bitcoin dropped 20%, 30%, right? It doesn't matter because you've actually reduced that volatility by investing over the long term and gaining the outperformance. Volatility is irrelevant if you're a long-term investor and you understand the assets you're investing in. I think we can split the areas that we need to learn about into 3 main categories. And I'll show you some other media and books and learning materials that you can take advantage of here. So I think the first one is macroeconomics. You have to have an understanding of how fiat currency works and how central banking works and how credit creation works. And once you understand that, you can really broadly identify the cycles that we go through because, like I said, everything is valued in fiat currency. So if fiat currency is debasing itself, if credit is being created, that creates these cycles in the market up and down. And it's important to understand what part of the macro cycle that we're in, because that is going to determine how assets generally perform in that environment. And so if we're in a bullish macro environment, you generally go long, right? If you're in a bearish macro environment, which in crypto, we get these bull and bear markets. If you're in a bearish macro environment, nothing else really matters, right? All your trades are going to fail and it's going to feel like you're failing because prices don't really go up in that environment. The second part is money, saving, investing over the long term. And then the third part is being very specific with trading ideas, technical analysis, how to actually read charts, etc. So I'll link all of these down below if you want to take a look at them. This is the Bitcoin standard. I think this comes under money and macro. We also have the price of tomorrow. Again, this is kind of a larger look at kind of trends in money and how assets are priced. So I'll link all of these below. Broken money here, more about macro and money. Then we go into Michael Saylor. If you go to, I think it's michael.com. Again, I'll link it below. Just a bunch of different resources here to really think about how assets perform over time and how we value things and how to expose yourself to the assets that are going to outperform. This YouTube series is insanely good if you want to learn about how money works, how human beings create and trade value over time. It's very important. It's hours and hours long, but it goes through the entire history of what money is and why assets are important versus fiat currencies. Something that I learned for many, many years This is the UK syllabus, but if you go over to America, you have different exams. Go to the exams of the financial regulator that you have in your country. Now, if you want to be a professional, you have to learn this stuff. Go and buy these books. So in the UK, this is what I got. These are hundreds of books right here. You can go through and learn the specifics of how markets work, different assets, how to think about them, how to analyze them, right? So if you're really serious, you can just go and buy the professional books. Now, the crypto course I put together really for beginners, just to learn specifically about crypto, how to use it, how to invest in it, tokenomics, technical analysis and trading, if you want to know how to actually go ahead and do that. So obviously link below as well, but there are many resources here. And so it's all there for you if you want to learn more. Now getting into the process of a trade. So there's really 5 steps here. So I'll go through them. Every trade, so now we're looking at the active part of your portfolio, which should be that bucket. So if you've got the buckets, right, 1, 2, 3, which is investing, your trades, and then your cash and everything on the side, right? And so this is bucket number 2, trading, could be 10% of your portfolio, right? The rest in here, you're just getting that outperformance. But there are opportunities over time to take trades. So look at this 5-step process. First is the catalyst. There must be some sort of catalyst for that trade. There must be some sort of reason that the price is going to re-rate in a fairly short period of time. So that's number 1. Then we look at the potential. So what is the potential return of that trade? What do you think is going to happen? Right? Do your analysis. And a lot of this is actually around time and news flow and events, right? So you can see that. Time horizon, how long is this trade going to play out? How long do you have the money tied up for? And at what point do you actually think this trade idea failed and so we have to get out, right? Because a trade is not something that you get into with the hope of making money kind of broadly, and then it kind of goes on and you think, what's happening, right? Is this trade working out, or is there's no specific time? You're just kind of in the trade then, and then maybe the trade goes south and you start losing money, and then you think, oh, what am I doing, right? And then you're kind of in the trade and you don't really want to take your loss because you're like, well, maybe it will come back, and you're in a mess, right? That is a weak position to be in. Specific events for trading. What's the catalyst? When is it going to occur? How big do I think that is going to be? And when am I going to get out because it failed, or get out because I'm making a profit and I won, right? And then we actually go and make that trade, entry and exit. So let's look at some examples of this. The first one would be a massive catalyst for the price of Bitcoin, which was the ETF launch. Now, analysis here showed me and many other players in the market that the Bitcoin ETF had to happen. And the reason it had to happen is because it had gone through years and years and years of litigation through the courts. And there was eventually a decision in the courts in the US that the SEC, who are blocking the ETF, could no longer block it. That came out during a bear market. And so prices were pretty low. And this amazing news came out when the market was completely uninterested in Bitcoin. Now, for people that were around here thinking, wait, this is a big catalyst. This thing has just been given court approval that ETFs can no longer be rejected. That is a big news. Now, the price of Bitcoin around that time was, I think, around this level, right? 20, 25, something like that, 25K, just coming out of a bear market. At that point, you had weeks and weeks to literally take a position, because in 6 months' time, there will be applications for Bitcoin ETFs and they'll be accepted. The courts literally said you have to accept them if people apply for these ETFs. That's a huge catalyst. People were asleep around this price. Now, as the news starts coming out, we start to break out, and then BlackRock and Fidelity and all the big guys start applying for the ETFs. They do not apply for ETFs willy-nilly. They're definitely going to get accepted because they have lawyers there, they have an army of lawyers saying this is certain, right? Still, the market's kind of, mucking around. Then you get the ETFs, right? In fact, ETFs on this specific month were a sell the news event, and everyone was saying, well, sell the news, sell the news. There's a lot of risk around there if you think about it, right? Because what happened was traders getting in here for the ETF announcement made a lot of money, and they were just getting out of that trade. That was a specific trade for them over a specific period of time. And you can't blame them for getting out. Now, it went higher after that because of, the Bitcoin ETFs are the best performing ETFs in history of any ETF product. So, they've done pretty well. But that specific trade was something came out in the market that the market didn't understand, didn't know, and didn't care about. That's the trade. Go into the ETFs get accepted. That is a trade. Specific trade with a catalyst, potential that you think is going to happen. You do your analysis, you know the time horizon, you know the specific dates, you get your entry and you get your exit. That's a trade. Now looking at buckets again. So within buckets, we can have buckets, right? So in your investing buckets, that could be a mix of S&P, NASDAQ, Bitcoin. Maybe you could put your house in there as well. If you're buying a house or you're paying a mortgage on a house, right? You're actually putting money into the house. You're gaining equity every time you pay the mortgage and a little bit of the principal, right? So that's, again, an investment over time. You're just outperforming the fiat currency. They're your buckets. You can split that up any way that you want. 100% Bitcoin, 100% house, put some S&P in there. It's up to you. The trading portion, you can also put that into buckets. Now, I personally think if you're a retail investor, right, individual, on your own, our brains cannot handle like 50 trades open at once, right? It's impossible. I've had it before with a lot of trades, and it is a nightmare. Like, just from a personal point of view, dealing with all of these things that are open and the prices are moving, you can't have that many trades open at once as an individual. I think you can barely have like a handful of trades open at once, to be honest, right? Because it's just too much. So think about the trades and think about these buckets. If you're looking at the trading bucket, right, that could be then buckets underneath here that you can put a few trades in and the trade ideas, right? So one would be, it's a standard savings asset. It's outperforming pretty much everything else. And so, you know, that could be your investment bucket, right? But then you have Bitcoin and ETH, which, what would be a trade here? We'll both have ETFs and are large proxies for crypto exposure. Both have been approved as ETFs, right? And then as of right now, you've got both of Bitcoin and Ethereum basically breaking out because the Republicans won and the Republicans were way more pro-crypto. And so that would be a trade that you could go into, or it just could be a kind of investment for these as well. So these are an investment because they're ETFs, they're institutional, they're going to grow over time, their exposure to crypto. That could either be an investment or it could be a trade if you want to do a 6 or 12 month trade because an election was coming up or some sort of decision, right? And then you have this more specific. So as you come down the list into smaller assets are much more volatile. So they can move in percentage terms a lot more than the bigger assets, right? Bitcoin now, a good move for Bitcoin in a day would be 6-7%. And that would be like, wow, that's a big move for Bitcoin right now, right? If you come down the list, these smaller assets can move 20, 30%, 40% in a day. Now that means it's way more volatile, right? Which means you actually have to expose lower to them because these things, they move slower. The percentage returns maybe aren't as much short term, right? But they're more reliable and they're going to outperform and they're just solid assets, right? As you come down the list, these things are way more volatile. So slightly more volatile for trading is sometimes a good thing if you're on the right side of the trade, sometimes a really bad thing. So again, it's the risk thing of not getting wrecked over the long term. If you're trading smaller assets, they're much more volatile. They can be much more volatile over a trade idea. For example, the Republicans won and they were way more pro-crypto. And so a trade idea is bid up USA projects that have been under the cosh, right? As have had SEC regulation against them, etc., because that's going to be lifted. That brings narrative and attention to those assets. And that is a trade idea. That's different from investing in them over the long term, right? So it's your choice about what you want to do, right? If you have a big stack and you just want to trade Bitcoin because 7% is a big move for you, right, over a week, you can put 500 grand in or something. Why do you even need to bother with these? These aren't going to have the liquidity and they're too risky and volatile. You don't need it, right? But if you're looking to take a bit more risk, maybe you trade those smaller assets and maybe you have a bucket of them rather than just one. So USA crypto projects could be Solana, Uniswap, Crypto.com, Coinbase stock, right? Anything exposed to that, that's going to get narrative and attention and people are going to bid it up. But you need to be ahead of the curve, understanding this and taking some risk before the actual thing happens, rather than kind of being at the tail end of things, right? So that's important. Also, it's why people take leverage on bigger assets, right? So on Bitcoin and Ethereum, people often trade with a bit of margin or leverage there because, again, it's a trade for them. They don't want to go into these smaller assets, right? They're far more volatile. People can sell the news and they drop 25%, right? So with Bitcoin, it's a bit more broad. And so the returns or the percentage moves aren't as big, but then you can take margin on that position as well. I won't get into margin in this video. I'll leave lots of trading examples of margin and trading on leverage down in the description if you want to do that. But I would suggest for beginners, never doing it. Just stick to it, stick to the plan over the long term. I'll link all the other specific trading videos down in the description for you alongside all the other resources as well. Deposit bonuses, the exchanges I use, and some other information about which exchanges and trading platforms are the best. I'm James, it's MoneyZG. Cheers for watching, and I'll see you in the next one.